Okay, so more people are coming. All right, so 16 people. So while I'm talking, if you have any questions, you can use the chat box. You can raise your hand. I will also have the question and answer box open. Okay. So let us screen share. All righty. So let me get everything all set up. I'm gonna get where's the chat box? There we go. I'll have the chat box as well. So today we are going to talk about insurance. So I don't know. Have you guys heard of insurance before? Have you heard that word insurance? Maybe, maybe not. Yeah. So you might have heard insurance, but you might not know what it is. Like, what is insurance? Well, here's the thing. Let me get my annotate. All right, spotlight. There we go. So here's the thing. It's about disasters. So disasters can hit anytime. Fires can strike during hot summers. Floods can happen after heavy rainstorms. Earthquakes can suddenly turn cities into rubble. Hurricanes can destroy coastal cities. So natural disasters, right? We have fires and we have floods and earthquakes and hurricanes. And all of these natural disasters can destroy things. So in America, on August 29th, 2015, Hurricane Katrina, very famous, infamous hurricane, struck New Orleans, Louisiana. The rain and fierce winds caused massive destruction throughout the city. Much of New Orleans lies below sea level. In the past, a series of levees is a fancy word for dams. So levees, they're like small dams. They hold back water, had protected the area from flooding. But this time, those levees failed in more than 50 different locations. The resulting damage was devastating. Yeah, Ellie, that's what we're gonna get to. So the point is, you have lots of destruction. What happens after exactly, insurance helps. Insurance helps pay for some of the damage. Exactly, Michael. So after water flooded more than 80% of the city and remained in many areas for weeks, more than 1 million people were forced to leave their homes. Damage were estimated $90 billion, making it the most expensive disaster in the history of the United States. So I like that question, Ellie. Yeah, what does this have to do with insurance? Well, that's where the next page comes in. Saved by insurance. Many people wanted to return and rebuild their homes after the floodwaters were drained. So there was a natural disaster and your home is destroyed. You want to rebuild your home, right? You want to go back to your normal life. Others plan to build new homes in different communities. Luckily, many of these people had insurance. Without insurance, very few could have afforded the cost of rebuilding. Their insurance policy paid their claims. So what is this idea of claims? So what does this phrase mean? Paid their claims. That's a very strange phrase. Well, what they claimed, their claims were for the losses of their homes. So their claims were for the loss of their homes and possessions. such as furniture, appliance, and automobiles. This is the key right here. They received money for the claims so they could replace their homes and possession. So what this means is it says, you know, I lost my iPhone 12. It was destroyed. So my iPhone 12 is, let's say, $1,000, right? $1,000. I will make a claim for $1,000. If I claim $1,000, the insurance company will give me $1,000 to buy a new. Exactly. So as long as nothing bad happens, no natural disaster, then the insurance company makes money. I don't know what just happened. That was weird. Right? So the insurance company only loses money when something bad happens. Right? So that's why we have a policy claims. So here's the thing though. The insurance did not cover the cost of all the destruction. Most homes and businesses had coverage for damage from wind and driving rain because of the storm. So there are different coverage. So coverage means what can I claim? And remember, what can I claim? This basically means what can I ask for money? Yeah, like auto insurance, exactly. So you can have home insurance. So what does my home insurance protect me? If there is an earthquake, will the insurance company pay me? If my house is hit by lightning, will the insurance company pay me? If there is a volcano, will the insurance company pay me? So here's the thing right here. Most insurance policies did not cover damage from flooding. Uh-oh. Uh-oh. Look over here. Look at all these houses. All of these houses are flooded. They don't get money from the insurance company. So damage caused by flooding, no money. No money because your damage was from flooding, not from rain. So yeah, Lisa, we're going to get to that. If there's no natural disaster, the company makes money because every year people must pay money. So every year we must pay the company money, like $100. Okay. So we're gonna move on. I know I'm skipping some, but I wanna move on ahead to a different part of the book. So let's see if I can move ahead. Yeah, because this gets into more talking about what exactly insurance is. So let's talk more about what is insurance. Yeah. How do I, oh my gosh, this is, there we go. All righty. So what is insurance? Well, simply, insurance is a way of protecting yourself and your belongings from the problems of everyday life. People need insurance to keep them safe. Insurance protects you from disasters, from bad things. So accidents can happen. So that's a great question, Brandon. Well, we can talk about that later, but I like your thinking. I like it. Accidents can happen. You might get sick. Your house might be robbed or damaged. You could lose your job. Without insurance, these problems may cost your life savings or force you to sell everything you own. So what exactly is insurance though? Well, insurance provides you money to cover the cost of unexpected problems. So let's read that. Insurance provides the money you need to cover the cost of unexpected problems. Money you might not otherwise have. So you get into a car accident, right? You get into a car accident. You need money to fix your car. But what if you don't have enough money to fix your car? Well, that's why you have insurance. Insurance will give you money to fix your car. Now, where does the company get this money? So like Lisa was saying, well, you have to pay what's called premiums. So right over here, how does it work? Insurance is a service offered by providers to nearly everyone. People and businesses purchase insurance by paying premiums or fees to the insurance company. So a premium is just the price of, is really just the cost of insurance. We give it the special name premium. I don't know why. Just a premium. A premium is the cost of insurance. What is the price of an insurance policy? Okay. So you pay the insurance company every month. So let's say I pay $200 a month for health insurance. Every month, the company gets $200. Whether I'm sick or not, the company gets $200. Only if I get sick does the insurance company pay. Same thing like natural disasters, right? Every month, I will pay the company money, $100, $200, whatever the premium is. As long as there is no natural disaster, the company is really happy. So, cost of the insurance you bought. Yeah, that we call that the premium. I don't know why we call it a premium, just we call it a premium, right? So overhead and profits. So here's the thing. I'm going to do red now, because I like red. With very few exceptions, insurance companies collect more dollars in premiums than they pay in claims. That makes sense, right? Basically, it's saying so collect more in premiums. So collect premiums equals revenue. So premiums, right? That's the revenue. Collect premiums, get money from you. Pay claims is cost. So Lisa, that's a good question. Sometimes, but usually not. Yeah, so actually, insurance companies are incredibly profitable. So insurance companies are really, really, really profitable. Yeah, so usually. So what do insurance companies do with this extra money? So we just learned that insurance companies make a lot of money. Well, insurance companies have many expenses related to running their businesses. They need office space, they need workers, equipment, computers, copiers, phones. All of these costs are called overheads. Okay. So overhead is the cost of equipment, phones, all of that. Okay. Any remaining company is profit for the insurance company. Just like William said, profits, profits, muhahaha. All right. All righty. I don't know what's going on with my computer today. Yeah, only 25% of the people that buy insurance. So there's an entire field called actuarial science. Let me see if I can spell this right. Actuarial. I don't know how to spell this. There we go. Actuarial science. This is a field of mathematics, actuarial science, and it has to deal with the probability of paying a claim. So it has to deal with risk. So if you're really good at math, you can become an actuarial scientist. You can work for an insurance company and they get paid really, really well. So in America, actuarial scientists get paid a lot of money. All right, so let's zoom in some more. Making money, right? So this is exactly what we're talking about now. So companies have to make profit, obviously. So companies have to make profit to stay in business. So what do? They need to make money so they can pay their claims, pay the overhead, and invest in the future business. So insurance companies make profit in two ways. They benefit by collecting more in premiums than they pay in overhead and claims. So premiums revenue. So they collect more revenue than they pay in claims. So revenue is greater than cost. Another one is they also make additional profits by investing the money they collect in premiums. So a lot of companies, what they do is they take the premiums and invest it. Money can be invested in the stock market where the value in the investment can grow. Of course, if you invest money in the stock market, it can also lose value. Their investments help the insurance companies generate money if they should have to pay claims. So here's the thing. Every year, I get money. You are paying me. I'm the insurance company. I don't actually have a lot of costs. My big cost is only when something bad happens. The overhead is not very big. So I take your money and I invest it in the stock market. But here's a really big question. But you do not always need me, exactly. But here's the big question. How much to charge for insurance? What should the premiums be? That's where actuarial scientists come in. So insurance companies have to make a challenging decision to make when they determine what to charge in premiums. So how much should insurance cost? If they don't charge enough, well, the company can't make a profit. So Michael, I actually agree. The stock market, you can make a lot in the stock market. You can also lose a lot in the stock market. It's a lot like betting. So if insurance companies charge too much their premiums will be higher than those of other insurance companies. Insurance companies are in competition with one another. They worry that people will set them out, will compete. Okay? So how do they decide what price to charge? Exactly, no one would want to buy it. So if you charge too much, no one would buy it. Okay? But we have another problem. So how do they figure it out? Well, insurance companies conduct research to determine how much to charge. For example, studies show that young automobile drivers have more accidents than drivers in their 40s and 50s. So think about that. So right here, young drivers have more accidents than drivers in their 40s and 50s. So if you're 20 years old, you're more likely to have an accident. So if I'm an insurance company, I will want you to pay me more money, right? You are more likely to cost me money. You are more likely to get an accident, so I need more money from you. Exactly, they have less experience. But older drivers, 40s and 50s, have fewer accidents. So their premiums are lower. The cost of their insurance is lower because they're less likely to cost me money. So young drivers pay higher insurance premiums. Elderly people have more accidents than any other age groups. So they pay the highest premiums. So old drivers pay the most in insurance. Now, here's another thing with car insurance. There's a lot of other things that go into car insurance. So other factors that affect automobile insurance premiums include driver education for young people, where the driver lives, how many accidents the driver has had. Okay? So for example, a driver who lives in a city and has had several fender benders. So I don't know if you know that. Fender bender means small accident. So fender is like the back of a car, and bender is like bends, small accident, bends a little. So fender bender means small car accident. Like you're going very slow. So like back of the car, you just hit the back of the car a little bit. Not big deal, just. So fender bender, a small car accident, will probably be paying a higher premium than the occasional driver who lives in the country. It also depends on the car you own. So if you own a really expensive car like BMW X7 or Audi Q7 or Maserati, your insurance premiums are really high because expensive car is expensive to fix. So the best way, if you want to pay low car insurance, get cheap car, don't have accidents, and be kind of my age, like 30 to 40 years old. All righty. So let's go on. So there are many different kinds of insurance. We've been talking about car insurance and house insurance, but there's many different kinds. So insurance is all about people protect themselves from unexpected costs by purchasing different types of insurance. Most of us need more than one kind of insurance to keep us safe. So insurance is about protecting yourself from accidents. Okay? So why do we need different kinds of insurance? Well, we face many types of risk nearly every day. So bad weather can destroy our property. What happens if lightning strikes your house and your house catches on fire? What happens if there's a gas leak and your kitchen explodes? What happens if a water pipe breaks and floods your house? These are not likely to happen, but they could. Exactly. Oh no. Yeah, that's why we have insurance. We can be hurt in an accident or become ill. Many people lose their jobs and the employer must reduce costs. We grow old. We need to protect ourselves from exactly everything can happen. Anything can happen. So we have lots of different types of insurance. Oh, where is it? All righty. So common different types of insurance. So individual insurance. So property insurance. We can insure our property. We can insure automobiles, homes, furniture, appliances. When you need it. So when would you use property insurance? Well, we've talked about when your home is destroyed or damaged, when your car or possessions are damaged or stolen, ooh, when a visitor is injured on your property. Ooh, okay. So Lisa, how do we decide what kind of insurance to buy? That's a great question. So sometimes government tells you to buy it. So everyone must buy car insurance and house insurance. Okay. Usually government law in, I think, all countries, even in China, you have to buy car insurance and house insurance. In America, I know you must buy house insurance and car insurance. Life insurance, health insurance, and government benefits, these are usually optional. You usually don't have to pay for it. But car insurance and house insurance, most governments make you. And usually it's a personal choice. So life insurance, this is interesting. You can insure your life. So what it covers, person's life and loss of employment income. When a family member dies, especially if that person's income is supporting the family. So I have a wife and a son. Okay? What happens if I get in a car accident and I die? What would happen? How would my wife and son support themselves? Where would they get their money? I know, wait, what? I have a wife and son. Is that surprising? I know, don't say that, but that's what life insurance is for. Knock on wood. So I'm knocking on wood now, right? But life insurance is, I can protect myself. So if something bad were to happen to me, my family, the insurance company would pay my family money. That's life insurance. Health insurance, when you get sick. All of you have seen a doctor, I'm sure. You go to the dentist, something happens. Yeah, exactly. This is when you get sick. Health insurance is probably the most common type of insurance that you know. Government benefits, unemployment insurance, right? You lose your job, the government will pay you money. Automobile insurance. So what this is saying up above is these are the most so these are the most popular. Will they be a millionaire? Oh, let's not talk about that. It's not the best outcome, but some insurance companies pay a lot of money. I want to see if this. So companies, I shouldn't laugh. That, yeah, bad accident. But there are companies who insure people. So this is true. This is true. Have you ever seen people model things on TV? So they go like, ooh, look at this. You can see a hand model. You can see the hand, but nothing else. We call them a hand model. Hand model. They will show hands, not their face, nothing else. They have beautiful hands. What if they get in an accident and their hand is ruined? You can insure hands. Singers. Some singers will insure their voice. So imagine you have a beautiful singer. You're a musician and you sing beautifully. You can get insurance for your voice, because what if something happens to your voice? You can get money from the insurance company. I know, it is absurd. Exactly. It's a little bit absurd, but that's the point of insurance, to protect you from the absurd. So funny, but true. All right, so let's move on. Let's go on to the next page. Clear all drawings. Ridiculous. It is. So one more practical type of insurance is business insurance, right? So we've been talking a lot about people needing businesses, but businesses need protection as well. Insurance ranks as one of the most vital requirements for any business. So why do businesses need insurance? Well, without proper insurance, a business can go from success to bankruptcy in the blink of an eye. Think about the different things that could go wrong with a business. A business differs from a home in many ways. Businesses usually employ workers, they provide products and services. The number of employees can range. Some businesses use, here's the thing, some businesses use dangerous and complicated machinery to make their products. Every business is responsible for the health and safety of its workers. In case, yeah, so what can happen is, what happens if a worker gets hurt? So a worker, someone works for me and you fall and you break your leg. So you work for me, and while you are working for me, you fall and break your leg. You can sue me. Unsafe work environment. I will sue you for damage. You broke my leg. Pay for my medical care. Well, I need insurance to protect myself from employees suing me. What if I own a restaurant? I own a restaurant and one of my customers gets sick. They ate some bad food at my restaurant and they got sick. They threw up bad food. They can sue me. Your company, your restaurant made me sick. Yeah, poisoned by accident. I will take you to court. I need insurance to protect me from that. So I don't pay, the business doesn't pay. The customer who got sick, I don't pay. The business doesn't pay. Insurance pays. So we're gonna go on the right side because this will be more clear on when I go over here. So let's go out to the right side. Oh my gosh, that's not what I wanted. I wanted this. right? So go up a little bit. Zoom in a little bit. All right, so go up. Okay, so kinds of business insurance. So if a worker is hurt on the job, if a shipment goes missing, so let's say I'm in China and I export something to America, but somehow the container gets lost. It goes missing. Who pays? What if the ship sinks? What if this ship is in a storm and everything sinks? Or a product causes harm to a exactly, not me, insurance pays. The business can be sued for damages. This can cost the business thousands or millions of dollars. With so many possible risks, proper insurance is vital for a business. Property insurance protects buildings and equipment. So what if my business burns down? What if there's a fire? Property insurance. This right here is really important. Probably new words for you. Liability insurance covers a business when it is sued for negligence or carelessness. So liability, do you know what that word liability means? We should stop me close. Liability means like blame. Like who is to blame for the cause? So liability, the blame. Who is to blame for me getting sick? So let's say you go to a restaurant. You eat some food and you get sick. Who is to blame? Who is liable for you getting sick? Is it the restaurant? Is it the person who made the food? Or is it something else? Was it not my fault at all? So liability is blame. So liability insurance is really insurance to protect me from blame. So liability insurance basically protects me from being blamed, right? If you want to blame me for you being sick, then I will get my insurance company to pay you. Or the person that cooked the food, maybe it wasn't my fault. Because negligence, do you know what negligence means? It's a really good word. Negligence means like stupid mistake. So if I'm negligent, I made a stupid mistake. So maybe, I'm trying to think of a good example for food. So maybe I forgot to put the food away. I had eggs and I just forgot to put the eggs away. The eggs spoiled, the eggs went bad. Just stupid, Andrew. Why did I make that mistake? So negligence just means silly, stupid mistake. So liability insurance protects me from negligence. Basically, liability insurance protects me from the costs of a stupid mistake. So let me put it this way. Liability insurance protects me from costs of making stupid and silly mistake. Kind of sort of makes sense. That's a really complicated business topic, actually. All righty. So let's move on, because let's see what the next page is. My house, my stuff. Oh. So we'll talk about this, because in America, this is really big. So in America, all right, I'll zoom out just a little bit. There we go. Okay. So every summer, there are reports about forest fires and wildfires. For example, the state of California and the province of British Columbia suffered from forest fires. So California in America has really bad forest fires. And I don't know if you remember, but a year ago, Australia had really bad forest fires. People build houses where there are fires. But people can't control the weather. Hot, dry weather, lightning, careless campfires, and even arson. So arson, people setting fire, can cause major disasters. These fires can destroy hundreds of homes and force thousands of people to evacuate. People can lose their homes and impression. That's the next page, Lisa. That's exactly what we're getting to. Insurance can protect people when a disaster occurs, such as forest fire. Most people have insurance for their homes and possessions, etc. But let's go to the next page. So who buys insurance? Well, here's the problem. Oh my God, I hate how this is, right? So to insure or not to insure, many people do not have insurance because they cannot afford it. So if you build a house where there's going to be a fire or where there is often a fire, it's really expensive. The insurance is really expensive. And you don't have to pay, in California, you don't necessarily have to pay for house insurance that covers fire, okay? Without insurance, they will not receive any money if their homes and property are damaged. In the case of a large-scale natural disaster, such as hurricanes or earthquakes, the government may step in. It can provide some emergency funding to help victims their day-to-day lives. So if the disaster is really, really, really big, maybe the government will help pay or will make certain exceptions. But if you live in California, you might have to buy earthquake insurance, but not fire insurance. So think about that. California in America has fires and it has earthquakes. Yeah, so who buys the fire for these insurance? Usually it's individuals. So I'm trying to think how to explain this, what the exact phrase is. Minimum. So Lisa, what a lot of governments do is they say minimum coverage. So what this means is minimum coverage is the minimum that insurance policy will cover. Maybe fire caused by, so you might have, so someone might buy fire insurance, but only fire caused by electrical problem, not forest fire. So minimum coverage says you need to protect your house from like fire from bad electricity or maybe accident. You left a stove on and you burnt your house down. You must buy insurance for that. That's the minimum coverage. But forest fire, we will leave that up to you. That is your choice. If you want to buy insurance for forest fires, you can, but you don't have to. And so that's exactly what this is, right? The other issue is that some people cannot purchase insurance for their homes even if they want to. Insurance companies can refuse to provide coverage if a home is located in a high-risk area. Okay. So in California, I don't think you can buy private earthquake insurance. If you want to buy earthquake insurance, the government provides it, or the government will subsidize it, because if there is an earthquake in California, it will probably be very bad. All right, so I want to see where we are in this book. So we're running out of time, so I want to talk about, so not if we get sick, let's see. So I'm going to briefly talk on some other topics. So what if I lose my job? So a lot of governments have unemployment insurance. So what usually happens is every month you will pay some taxes. So some of your tax money, some of your taxes go to fund unemployment insurance. Usually unemployment insurance is operated by the government. So some of your tax money, well, not you, but your parents, your taxes go to pay or fund unemployment insurance. So if you lose your job, you can get some money. This is what we talked about, life insurance. What about the future? This is all about life insurance. We're not going to talk about the details of life insurance. All right. Group insurance. We're not going to talk about group insurance too much. How do you get insurance? Usually you can buy insurance on the open market. What we say is there's lots of insurance companies. In America, trying to think, in America, there's Allstate, there's Geico. In China, there's PICC. I think that's what it's called, PICC. I forget. I don't actually know too many Chinese insurance companies. Shopping around. All right. Oh, is it? Allstate is John. Oh. Okay. I'll believe you. I have not watched American TV in a long time, so I haven't seen their commercials. Shopping around. So before we go to, oh, interesting. So before we get to questions, there's one last thing I want to talk about. Extended warranty. Have you ever bought something from like AppleCare? Do you know that AppleCare? When you buy an electronic, like you buy a phone and they say, oh, if you give us an extra $400, if your phone breaks, you can get a new one. You buy a TV and they say, oh, do you want an extended warranty? If you pay an extra $200, you can insure your TV. If your TV breaks, you will get a new one. Yeah, so extended warranty is very controversial. Some people really like extended warranties, other people don't. All right, so I will open it to questions now. So does anyone have any questions about insurance or anything else?
Hi.
Hi.
I would like to ask one question, which is about how does the insurance company decide how would they pay you how many dollars or RMB if you got sick or if you got injured? Like just a few days ago, there was a skiing place who has people falling down, and he passed away. And I would like to ask, how does the insurance company decide how would it pay how much for this people or whatever in the society?
It's it's really complicated. I don't have a simple answer for you. It's detailed in what we call the policy document. So insurance have a really, really long contract. Insurance is really complicated. And in that policy document, so the policy document is the contract between you and the insurance company. And that policy document is really long because it tries to explain every possible situation. And so what they will do is what you'll do is it's called a claims adjuster. Claims adjuster. What a claims adjuster do is they investigate what happened. So they will go to, let's say someone fell down at a ski resort. A claims adjuster will go there. They're like an investigator. And they will say, what happened? What are the facts of this case? What exactly happened? Was the person skiing drunk? Were they drunk and fell down? Were they tired and exhausted? What about the snow? What they do is they try to find who is liable. They try to find out the liability. And what usually happens is they assign liability. So what a lot of times do, a lot of policies will say is like, we will pay at most, let's say $1 million. All right. So it will say like, if you fall down at a ski resort and die, the most we will pay is $1 million. But what they'll try and do is the insurance company will say, well, it's not all their fault. You are to blame for 60% of the accident. So we will only pay 40%. So because you are 60% responsible, we won't pay $1 million, we'll only pay $400,000. That's basically it.
Okay, thank you.
All right. Excellent. Well, it's almost 9 o'clock. It has been a pleasure as always, and hope to see you all around next time. Bye-bye.